Here is a puzzle that has stumped even seasoned Wall Street professionals. The American stock market keeps setting record highs. Millions of working people feel like they are falling further and further behind. Even as corporate profits surge relentlessly upward, paychecks are not growing. The gap between boardrooms and kitchen tables has never felt wider or more uncomfortable. Understanding why that gap exists reveals something uncomfortable about who this economy is actually built to reward. When Trump returned to the White House, markets absorbed the shock of sweeping tariff hikes and geopolitical turbulence, then marched upward anyway. A sharp sell-off on Liberation Day briefly rattled investors when the administration announced its most aggressive trade barriers. But the dip was short-lived. Stocks recovered, climbed, and eventually notched a string of all-time record highs. This pattern is not unprecedented. Obama saw stocks climb 49% in his first term after inheriting the 2008 financial crisis wreckage. Trump's first term produced a similar surge. Biden navigated COVID and rising interest rates, but still managed meaningful gains. The beginning of a presidency has historically been a good time to own equities, regardless of which political winds are blowing. What makes the current moment feel different is the sheer resilience of corporate earnings against persistent inflation and geopolitical disruption. Analysts had expected earnings growth to slow. Instead, growth accelerated through 2025, and projections for 2026 show even steeper gains ahead. Forecasters are not just holding estimates steady. They are actively raising them as multiple forces converge to boost corporate performance. Companies have aggressively cut costs, slimming workforces, and squeezing more output from fewer people across every sector. Tax relief from recent legislation has added directly to the corporate bottom line, quietly fattening profits without touching worker wages. And then there is artificial intelligence, which deserves its own chapter in this economic story of winners and losers. The scale of AI investment by technology giants is almost difficult to comprehend, reshaping entire industries from the inside out. The hyperscalers were spending roughly $80 billion annually on capital expenditures back in 2020. Already an enormous sum. That figure has exploded to $675 billion today, an increase of more than 8 times in just 6 years. That money ripples outward through the economy. Data centers commissioned, construction workers hired, supply chains humming with new activity. Profits flow upward through dozens of industries connected to the AI build-out, creating a cascade of corporate windfalls few predicted. Simultaneously, companies across every sector report that deploying AI internally is making operations measurably more efficient than before. For corporate earnings, AI has functioned as a quiet but extraordinarily powerful accelerant, supercharging profits in ways unseen before. But not every corner of the market has shared equally in this prosperity, and the fault lines are starkly revealing. Consumer staples companies selling everyday goods have actually lost ground since Middle East conflict pushed energy costs sharply higher. Airlines are being squeezed by fuel prices. Utilities face the same relentless pressure from elevated energy costs across the board. Materials companies relying on commodities have been buffeted by inflationary forces, their margins eroding beneath the surface. Meanwhile, technology heavyweights absorbed early tariff hits and AI panic, but have since rebounded strongly beyond prior peak levels. Oil companies stand apart as clear beneficiaries, riding the commodity price surge that has damaged nearly everyone else's bottom line. For individual workers, the picture is frankly discouraging, a slow, grinding reality, far removed from the market's triumphant narrative. For a period, wage growth was narrowly outpacing inflation, giving households a thin edge in real purchasing power. That edge has since evaporated. Wages are drifting lower in their rate of increase, while inflation stubbornly refuses to cooperate. The result is that consumers are effectively treading water, running hard, but gaining no meaningful ground against rising costs. Gas prices well above $4 a gallon are taking a visible bite out of household budgets, already stretched dangerously thin. Paychecks are not rising fast enough to compensate for the compounding pressure of fuel, food, and shelter costs climbing together. The mechanisms lifting corporate profits, cost discipline, and AI-driven efficiency and workforce reductions compress working Americans' economic experience. The stock market's triumph and the paycheck stagnation are not separate stories. They are two sides of the same economic coin. Which side you land on depends almost entirely on whether you own capital or simply sell your labor in this unequal economy.